Gold just had its best day in 17 years. Silver crashed 27% in a single session before rebounding 5%. And right now, as US warships are shooting down Iranian drones in the Arabian Sea, one metal is climbing back toward $5,100 per ounce. If you think this doesn't affect you, you're about to find out why your purchasing power, your savings, and your financial future are being reshaped at this very moment. Stay with me for the next 5 minutes because what's happening right now hasn't been seen since 2008. Let me give you the raw data first because these numbers tell a story that financial analysts are struggling to explain. As of 6:55 GMT on Wednesday, February 4th, spot gold shot up 2.8% to $5,076.01 per ounce. But here's what makes this extraordinary. Just one day earlier, on Tuesday, gold surged 5.9%. That's the biggest single day gain since November 2008. Let me put that in perspective. November 2008. That was the height of the global financial crisis. Lehman Brothers had just collapsed. The world's banking system was on the brink. And gold responded exactly as it's designed to respond in moments of extreme uncertainty. Now it's happening again. But we need to zoom out to see the full picture. Last Thursday, gold scaled a record high of $5,594.82 per ounce. Then came Monday. Gold plummeted to $4,403.24, marking its biggest two-day sell-off in decades. A drop of over $1,100 per ounce in just 48 hours. Think about that volatility. That's not normal market behavior. That's panic. That's uncertainty. That's massive capital flows moving in and out of safe haven assets at speeds we haven't witnessed in over a decade. And it's not just gold. Silver rose 5% to $89.38 per ounce on Wednesday. But here's the truly shocking part. Silver touched a record high of $121.64 on Thursday, then fell to a month low of $71.33 on Monday. That Friday crash? A 27% single session price wipeout. That's the largest single session decline on record. Platinum added 4.2% to $2,302.56 per ounce. Palladium gained 3.5% to $1,794.15. US gold futures for April delivery climbed 3.3% to $5,097.20 per ounce. Every single precious metal is moving in tandem. This isn't a coincidence. This is a coordinated market response to something bigger. So what triggered this unprecedented movement? The answer came Tuesday evening from the US military. The United States military shot down an Iranian drone that aggressively approached the Abraham Lincoln aircraft carrier in the Arabian Sea. This is a direct military confrontation between American and Iranian forces in one of the world's most strategic waterways. Let me explain why this matters to your financial future, even if you've never invested a single dollar in gold. The Arabian Sea is a critical choke point for global trade. Oil tankers pass through these waters daily. Any escalation in this region doesn't just affect military strategy, it affects energy prices, inflation, supply chains, and ultimately, your cost of living. When investors see military confrontations in strategically important regions, they don't wait to see what happens next. They move their capital into safe haven assets immediately. Gold is the ultimate safe haven asset. It's been a store of value for over 5,000 years, surviving every empire, every currency collapse, and every geopolitical crisis. According to Sonny Kumari, an analyst at ANZ, after such a sharp rally, a correction was expected. It was not surprising, and with gold coming back up, the fundamentals have not changed much. The geopolitical and economic backdrop remained mostly unchanged. Let me translate that for you. The fundamentals driving gold higher are still in place. The Monday crash? That was profit-taking after an extraordinary rally. It was technical, but the bounce back on Tuesday and Wednesday, that's fundamental demand returning because the underlying reasons to own gold haven't disappeared. The US-Iran tensions are just the visible trigger, but beneath the surface, there are deeper currents moving this market that you need to understand. Here's where this story gets really interesting. And this is information you won't hear on mainstream financial news. Goldman Sachs issued a statement on Wednesday. They said they see significant upside risk to their $5,400 year-end forecast for gold. Their reasoning? Central banks are maintaining their recent pace of gold accumulation alongside private investors stepping up gold ETF purchases. Let me break down why this is absolutely critical information. Central banks are the institutions that print money. They control monetary policy. They have access to economic data that you and I will never see. They employ hundreds of the smartest economists on the planet. And right now, they're buying gold at a pace we haven't seen in modern history. When central banks buy gold, they're essentially hedging against their own currencies. Think about what that means. The institutions responsible for maintaining the value of the dollar, the euro, the yen, they're buying an asset that typically rises when their currencies fall. This isn't conspiracy theory. This is public data from the World Gold Council and central bank balance sheets. Central banks added significant gold reserves throughout 2024, and they're continuing that trend into 2025. Goldman Sachs doesn't make bullish calls lightly. They're one of the most influential investment banks on the planet. When they say there's significant upside risk to a forecast that already has gold at $5,400, they're telling you to pay attention. But Goldman's target isn't even the most aggressive forecast out there. Jigar Trivedi, a senior research analyst at Indus Insecurities, stated, "Going ahead, we are expecting the same $5,600 levels for gold by the end of the first half or April end, while prices will continue to rise thereafter, and our year-end target is $6,000 per ounce." $6,000 per ounce. That's an 18% increase from current levels by the end of 2025. Now, I'm not here to tell you whether gold will hit $6,000 or not. I'm here to tell you what the professional analysts who spend 80 hours a week studying these markets are saying, and more importantly, why they're saying it. The private investor component is equally important. Gold ETF purchases are accelerating. These are regular investors, pension funds, and institutional money managers who are allocating capital to gold. When both central banks and private investors are moving in the same direction, that creates sustained buying pressure. This is not a short-term trade. This is a structural shift in how sophisticated investors are positioning their portfolios. Now, we need to connect the dots between gold prices and something that directly affects every person watching this: Federal Reserve policy. The script mentions that markets are awaiting ADP private payroll data for more cues on the Federal Reserve's policy path. There's also been a partial US government shutdown that has delayed the closely watched employment report for January. Here's why this matters. The Federal Reserve has two mandates: maximum employment and stable prices. Right now, they're trying to navigate an incredibly difficult situation. If employment remains strong, the Fed may keep interest rates higher for longer to control inflation. Higher interest rates typically make gold less attractive because gold doesn't pay interest or dividends. You're giving up yield to hold it. But here's the paradox. Even with interest rates at levels we haven't seen in years, gold is at record highs. That tells you that investors are more concerned about currency debasement, geopolitical risk, and systemic instability than they are about the opportunity cost of holding a non-yielding asset. The employment data matters because it will influence the Fed's next move. But the fact that gold is rallying despite high interest rates suggests that market participants don't believe the Fed can maintain tight monetary policy indefinitely. Here's the reality. The US government is running massive deficits. Interest payments on the national debt are now one of the largest line items in the federal budget. The longer rates stay high, the more expensive it becomes to service that debt. Eventually, either spending gets cut dramatically or the Fed will need to lower rates and effectively monetize the debt. Both scenarios are bullish for gold. Spending cuts would likely trigger an economic slowdown, driving safe haven demand. Monetary easing and debt monetization would debase the currency, making hard assets like gold more attractive. The Federal Reserve is in an impossible position, and sophisticated investors know it. That's one of the fundamental reasons gold continues to find buyers even after a 5.9% single-day rally. The partial government shutdown adds another layer of uncertainty. When government function is disrupted, even temporarily. It creates questions about political stability, fiscal policy, and the ability of institutions to function effectively. That uncertainty drives safe haven demand. Let's talk about silver for a moment, because what happened to silver is genuinely extraordinary and it offers lessons for every investor. Silver hit a record high of $121.64 on Thursday. By Monday, it had crashed to $71.33. That's a 41% decline in just a few trading days. Then came the Friday crash I mentioned earlier, a 27% single session wipeout. But on Wednesday, silver rose 5% to $89.38 per ounce. It's recovering, but with enormous volatility. Why does silver move so violently? Because silver is both a monetary metal and an industrial metal. It's used in electronics, solar panels, medical equipment, and countless industrial applications. When economic uncertainty rises, demand for physical silver as a store of value increases. But when fears of economic slowdown emerge, industrial demand concerns can trigger selling. Silver is gold's volatile younger sibling. It tends to amplify gold's moves in both directions. When gold rallies, silver often rallies harder. When gold corrects, silver typically corrects more severely. The 27% single-day decline is a warning about leverage and volatility in precious metals markets. If you're going to participate in this sector, you need to understand that these are not stable, predictable investments. They respond to macro forces that can shift rapidly. Now, platinum and palladium are equally interesting. Platinum added 4.2% to $2,302.56 per ounce. Palladium gained 3.5% to $1,794.15. These platinum group metals are primarily industrial. They're used in catalytic converters for vehicles, in chemical processing, in electronics. Their price movements tell us that industrial demand concerns are being offset by the same safe haven and inflation hedge dynamics driving gold and silver. When all four major precious metals move in the same direction, it's a clear signal that macro forces are dominating market behavior. This isn't about individual metal supply and demand. This is about systemic concerns driving capital allocation across the entire precious metals complex. Let's bring this home. What should you actually do with this information? First, understand that this is not investment advice. I'm not a financial advisor, and your situation is unique to you. But I can give you frameworks for thinking about what's happening. Takeaway 1. Volatility is the new normal. The days of steady, predictable markets appear to be over. Gold moved over $1,100 in 2 days. Silver crashed 27% in a single session. If you're invested in any market right now, you need to be prepared for extreme volatility. That means position sizing matters more than ever. Never invest more than you can afford to lose in any single asset class. Takeaway 2. Safe haven demand is structural, not temporary. When Goldman Sachs talks about significant upside risk and analysts forecast $6,000 gold, they're not talking about a short-term trade. They're describing a multi-year trend driven by central bank policy, geopolitical instability, and currency debasement concerns. This suggests that having some exposure to hard assets as part of a diversified portfolio may be prudent. Takeaway 3. Watch the employment data and Fed policy closely. The ADP payroll data and the delayed January employment report will provide critical insights into the Fed's next moves. If employment softens, expect the Fed to pivot toward rate cuts faster, which would likely be bullish for gold. If employment remains strong, the Fed may keep rates higher for longer. But as we've seen, gold can rally even in that environment if geopolitical and systemic risks remain elevated. Takeaway 4. The US-Iran situation deserves your attention. Military confrontations in strategic regions can escalate quickly. The Arabian Sea incident is not isolated. It's part of a broader pattern of geopolitical tension between major powers. These tensions affect energy prices, supply chains, and ultimately inflation. Stay informed about geopolitical developments because they're directly connected to your purchasing power. Takeaway 5. Central bank behavior is a signal. When the institutions that print money are buying gold aggressively, that's information. They're hedging their own monetary systems. You may want to consider whether you should be doing the same on a scale appropriate to your situation. Takeaway 6. If you are considering precious metals exposure, understand the volatility. The silver crash is a perfect example. These assets can move 20 to 30% in days. If that kind of volatility would cause you to panic sell, these assets may not be appropriate for you. But if you can hold through volatility and you're looking at a multi-year time frame, the structural case for precious metals remains intact, according to professional analysts. Takeaway 7. Diversification matters more than ever. Don't put all your capital in any single asset, whether it's stocks, bonds, real estate, or precious metals. A diversified approach helps you weather extreme market movements. The goal is not to maximize return on any single trade. The goal is to preserve and grow wealth over time while managing risk. Final thought. We're living through a period of extraordinary uncertainty. Record gold prices, historic volatility, military confrontations, and central banks preparing for scenarios they're not discussing publicly. You don't need to be a financial expert to recognize that something significant is happening in global markets. The question is not whether you should pay attention. The question is what you're going to do with this information. Stay informed, think critically, make decisions based on your unique situation and risk tolerance. And remember that in times of uncertainty, knowledge is one of your most valuable assets. That's the situation as it stands on February 4th. Gold near $5,100. Silver recovering from historic volatility. Precious metals across the board responding to geopolitical tensions and systemic concerns. And analysts forecasting significantly higher prices by year end. If you found this breakdown valuable, make sure you're staying updated on these developments. These markets are moving fast, and the implications reach far beyond just gold prices. This is about the global financial system, currency stability, and your economic future. Thank you for your time and attention.